Welcome to the Money and Wealth Show, brought to you this week by AmericanManganeseInc.com. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, the program that offers you opinions every week on business, the economy, and the markets. And this week, it's a real pleasure to welcome back to the program from Venable Park Investment Counsel in Barrie, Ontario, portfolio manager and financial analyst Danielle Park. Hello.
Boy, you're good, Sterling. You're so smooth. Holy, that's very good. How are you?
I'm well. It's great to have you back with us.
Thank you.
Now, you were in town recently, in fact, last weekend, to speak to the World Resource Investment Conference. You made one presentation in front of a couple of thousand people. What was the message?
The topic on it was the madness continues with the credit derivatives bubble. Basically looking at the impact of derivatives and how they have escalated things like commodity prices.
Can I stop you right there? Because this is important. What are derivatives,
All
please?
right.
It's something that everybody throws around like popcorn, and most folks don't get it.
I know. Well,
and I'm in that crowd.
Listen, they're very hard to get,
Okay.
frankly. What they are meaning is it's something that's derived from something that people would otherwise know. So a stock, a bond, a piece of property, a tangible asset.
Right.
So it is an interest that is traded that gives you some right to call or sell that particular underlying security without necessarily, you may not take delivery of it at all.
So you don't ever actually own it. You just own an access to it.
You own the right to decide if you want to have access to it.
So why are they so popular?
Well, because basically what happened was first of all, it began as a over-the-counter market between institutions, where if you were a seller of corn, perhaps you wanted to sell it forward at current prices. So you were doing it as a hedging mechanism.
Okay.
So you were trying to control your risk to a particular price cycle. So that was a legitimate use for people to be able to hedge their risk, producers.
Right.
That's how it started. And then what happened was it started to become more lucrative in terms of commissions and the transaction end of it started to generate revenue, and then suddenly Wall Street and various other places in the world became quite incented to be very creative in this particular area. So I remember, for example, looking at the data on this derivatives market back in the 90s, the late 90s, and the total derivatives at that point that were trading were estimated to be about $250 billion. So circle forward to today, Sterling. The current estimation is at, wait for it, $1.2 quadrillion.
Okay,
dollars.
serious.
Okay?
Really?
Now, quadrillion is something that most mortal folks.
That's what little kids say when they try to think of the world's biggest
Gazillion,
number.
quadrillion,
Yeah,
right?
right,
Yes,
right.
absolutely. But here is the way to think about quadrillion. Quadrillion is if you were to count $1 per second starting right now, and you were going to count all the way to 1 quadrillion, it would take you 32 million years to do so.
Oh my.
So
okay.
that gives
So
you
that's
some.
the derivatives that are out there at play right now.
Right. So about half of that amount trades on the over-the-counter market. About half that amount are listed. Now, the way I like to think of derivatives is that they are ultimately the line of credit in the sky that has allowed the credit bubble to come the way it did. If you think about it, why is it that we've all been able to get so many things and buy everything with no real money? Why is it that people have no savings, no money down, and everybody got a house and furniture and cars, and you don't pay for years and there's no interest?
And once you get that house, well, then you can buy everything else based on the equity supposedly in your
Derived
house.
from.
That's right. There's your derivative. Okay. All right.
You see, so once you take a notional asset, you can derive a whole bunch of instruments off of it. So what it does in effect is create leverage in the system.
Okay.
So it's like, so anyway, what's happened at now is it's become so enormous. It makes no sense of any kind. And it's really creating, in my view, many of the bubble prices that we're seeing in things that matter. So the derivative instruments have jacked prices up on the real things that the rest of us actually need to live.
Okay.
Okay, so I'm saying that that has brought us into the next level of credit risk in the world in terms of how sovereigns are now being hit with, too much debt. And if something happens on the derivative market again, which I think is quite likely given the amount of players and the amount of layers of this thing, then all of a sudden it could really hurt the world economy.
Now, I'm trying to think back to the crash in 08, 09, and banks selling customers one product and other customers another product based on the failure of the first product. Was that a derivatives transaction?
Basically, that's correct. Yeah. So Lehman Brothers, went bankrupt because of derivatives, but the exposure there was like something like $13 trillion of derivatives. And long-term capital in the late 90s went bust because of its derivative exposure. Nick Leeson, Barings Bank in England, derivative exposure. So we've had many occurrences of individual institutions succumbing to the inevitable blow-up of derivatives, but the whole system is now full of them. So that creates a lot of risk in my view.
Well, I want to take a break, but I've got to finish this portion off first. Why do you think that there's going to be another crisis based on derivative malfeasance or just activity?
It's just another enormous layer of risk that's overriding everything today. And what happens is that you get into a downturn in some of the fundamental aspects of the economy, like we're seeing now. You get things like an earthquake, a tsunami, these extra shocks, and they can be the tipping point that causes the dominoes of all these derivatives to start to eat itself, basically, and then we all have to live with the consequences.
And because we've had a couple of those events in recent times, this would suggest we're kind of set up for this then.
And it particularly speaks to a new report today from the UN on the commodities bubble.
All right, we'll talk about that in a minute, okay? Our guest is from jugglingdynamite.com. That's the website I wanted to remind you about as well. Danielle Park is back with us on the Money and Wealth Show. Lots more ahead. Please stay with us.
Always consult your investment professional before making any investment decision.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at TalkDigitalNetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our special guest this week is financial analyst and portfolio manager and author Danielle Park. Juggling Dynamite is both the book and the website. This week, just before we took the break, you talked about a warning that's come out in the past few days from the United Nations, of all people, about a commodities bubble. What are they talking about?
So they were saying that the speculation and levered players in the commodities field in the last couple of years has hiked prices to such a point that it's creating starvation, lack of ability to buy food in many countries in the world, as well as energy friction, like increase in energy costs above what it should be relative to the demand in the world. And their take on it was that there are so many institutions that are now making good dollars, profits off of this area, this trading area, using leverage in this space, that there's no incentive in the system to correct itself. And so they're saying they think governments have to actually step in to try and regulate the space, to try and prick the bubble, is actually the words they used.
Okay, well, I have a few issues with the United Nations, and I've never considered them one of the world's great economic authorities, but there is no questioning the rising cost of food, Danielle, is going to be a major problem in many parts of the world. Hungry, desperate people do desperate things, and we're seeing some of that already in the Middle East. Do you anticipate more of that? Because I don't see a slowdown in commodities prices, do you?
Well, this is where we go back to, if world demand is on a sort of a relatively increasing curve for things like food, as population grows, et cetera, then that's really how the price should plod along. What's happened is with this overlay of leverage, the way that I'm describing the derivatives market, now price has been extremely volatile and not connected to that basic supply curve or demand curve. And so that's why an event in the financial markets could trigger a massive sell-off that would quickly correct prices. in some of these basic assets. So that would be good for the general population again, but it could create mayhem in terms of the financial markets. They were also speaking about the fact that nowadays assets like commodities have become a financial instrument, whereas traditionally they were used as a demand consumption unit. You know, that we needed those things to live. But now they are trading in a world of their own, so to speak, and that's creating all these imbalances and problems. So they're just basically saying there needs to be someone who's not on the take, who's not getting commissions and money from the process, who can say, no, here's the rules, you can't be, you know, more levered than this in these markets, you can't trade larger positions than that. There has to be some public interest in controlling the way in which prices move in those areas.
Well, you know, there are two schools of thoughts vis-a-vis government regulation or intervention in the marketplace. Some say government should just please back off. Let the market, the Austrian economists, right? Let the marketplace sort itself out. If a company is going, there's no such thing as too big to fail. If a company isn't well enough run, it should fail. You're not in that school. You have some time for some government intervention or involvement in the economy, don't you?
Well, the problem I have is that those other examples I cited of when derivatives have bust institutions, you know, like in the past with respect to long-term capital, with respect to the credit crisis in 2008, when all hell broke loose in the commodities markets and in financial markets, the government stepped in then. Right, the banks basically were bailed out. The risk takers were bailed out. That was the fundamental flaw. Because if that had been allowed to puncture at that point, just as if they'd allowed it to puncture with the previous disasters instead of trying to save it, if they'd allowed it to go then, we wouldn't be in the excessive state of bubbledom that we are today.
Because the market would have really kind of sorted itself out.
Yes.
It wouldn't have been pretty, but it would have eventually resolved itself.
Right, and I think that's the lessons we've learned from places like Japan. You know, the government keeps stepping in trying to bail it out, which just elongates the pain, makes the risk that much greater, you know, makes the disparity between who's profiting and the rest of the world that much wider. And that's why there's great inequity in it. If they'd have just let everyone take their lumps, it wouldn't have got so like the beast it is today.
So speculators are ultimately responsible for the rise and fall of prices. Who are speculating on specific commodities like food? What is driving that up more? What sector is driving that cost of food so high that poor people in poor countries are really stressed and really hungry?
Okay, so it's many different players. It's a complex question, but essentially it is investment banks, who, by the way, Sterling, have been garnering 55% of their profit growth in the last year off of precisely this area.
Okay.
So we know from their the financial disclosure that we get on where revenue's coming from in the investment banking sector used to be all on securitization. You know, writing bad debts into packages and selling them to everyone. That's kind of gone by the wayside now because of all the problems. They blew that up, and now we move down here, and we're trading our brains out in commodities.
Since we've ruined the mortgage market.
There you go.
Okay.
So now the same crew is down the road doing this in the next hot area.
Okay.
At the same time, though, we have a investment thesis that's been sold, which is that commodities are an asset class, that portfolio managers should use them, that retail investors should use them vis-a-vis ETFs, indices, you know. So there's been this huge surge in people packaging these products and selling them, not for use, but for investment purposes,
Sure.
right? And that in itself has the impact of driving price up because they're doing that with a view to buying it now and having it go higher. So it's sort of a self-fulfilling phenomenon at that point. So it's many different players, and then we also know that the margin use in this area is extremely high, so the people that are participating are doing it on a lot of leverage. So you've just got leverage on leverage on leverage on leverage, and guess what? Prices go higher until they don't, and then they usually, you know, collapse in a spectacular fashion. So
our guest this week from jugglingdynamite.com, financial analyst and opinionated person, Danielle Park. Back with lots more right after this.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer averaged 182 ounces per ton. Trading symbol MOR. Website mollycorp.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Danielle Park from jugglingdynamite.com and Venable Park Investment Counsel in Barrie, Ontario is back with us. Danielle, you've done a fine job of describing, well, really in great detail, the mess we're in. But I notice you always refrain from being dark, bleak, and pessimistic. And there are a lot of people out there quite happy to say basically the dollar's collapsing, the world is ending, it's going to be terrible and awful. You're a relentless optimist, and that's why I appreciate you so much, but you're also an incredibly practical person. So with all of this stuff staring us in the face and all of these bad experiences behind us, how do we steel ourselves to get through the next wave of bad stuff?
Well, I think it may be actually in process at the moment. We're seeing that the equity markets around the world are in their next phase of significant contraction that continued in the last week. The US dollar has been rallying relative to the world's benchmark currencies. The Canadian dollar's weakened again because if this commodity story plays out in terms of significant declines again in commodity prices, that suggests the Canadian dollar is going lower. The Canadian economy is probably going to disappoint for a little while here. So I think what I'm trying to say is we've been in this unnatural state, which is our risk presently in the world. But as the process plays out, we may indeed get another meaningful buying opportunity in terms of real stocks, real bonds, real things that you can invest in.
Attached to realistic values, perhaps?
Right, from an investment perspective where you're buying it for this and there's a dividend flow and it's a reasonable value again, which we haven't had that now for a couple of years, frankly, because of all the stimulus efforts that have gone in to try and pump everything up. So I think what people should do at this point is realize the conditions, realize the risks, realize that it's been overpriced again. The expectations of what GDP we were going to get have been overpriced. The expectation of peak earnings continuing at the pace they were at is overpriced. Okay. So fine. So that's not the end of the world. That's just a question of letting the price be rediscovered in terms of what it should be, and then having some liquidity available to go in and take advantage of it again. So the phase we're in now, there's no way to know exactly how long this will go on, but we should all realize that it could be as much as a 45% decline again, because we could be headed back into another recession. So that would just be typical run-of-the-mill. Whenever I say that to people, sometimes they go, "Oh, that would be awful. Don't say that. That's terrible." But that's the norm in this environment. It is the typical scenario where a contraction turns into a recession when you're in the midst of a credit deleveraging cycle, when you're in the midst of a secular bear. That's just regular. So you don't have to be hurt by it. You just have to stand aside and let the sort of next phase correct, and then go in and sort of look for opportunities with your liquidity again. Okay, now by standing aside, you mean take your profits off the table while they're still there to be taken, right? And you're suggesting stepping back altogether, or maintaining certain core positions and staying in cash with the rest? What's the balance you're suggesting? Well, that everyone has to have their own rule set, and I always say you got to set this up before the crisis hits so that you know what you're doing. There's a lot of managers in the world who are not allowed to go heavily to cash at a time like this, for example. So you'll often hear them say, well, if you have to be invested in equities, then I would suggest that you go to drug companies, consumer staples, things that'll be, quote, defensive in a downdraft. But if you don't have to be in equities, and I say this to individuals, you don't actually have to stay in equities. If you see this train a-coming, you don't have to lie down and let it hit you, That's right? Yeah. So I'm just saying that at that point, you should be able to take profits. You should be able to step aside. And the reason most people don't is twofold. Usually because they don't understand the climate, and they think they're on that mountain, not the crazy ride that's a secular bear.
Okay.
So they think, well, I'll just stay on, it'll end up higher. No, not necessarily. And secondly, I think they're also afraid to miss out. So they're afraid that they'll sell and it might go up again for a little bit.
Right.
But that's the emotional maturity that I talk about often. You really have to be prepared for that, because...
And on an emotional, to use an emotional verb, you really do have to divorce yourself from your holdings, don't you? It has to be strictly business.
Well, you have to know what your rule set is, know why you sold it, and know when you'd look to buy it. And when you have that kind of work done up front, it's not emotional decisions. Like someone saying to me today, well, or, you know, if the people are buying the US dollar in times of trouble, isn't that an emotional decision? I don't think that it's an emotional decision to the extent it's a park. They're saying, of all the choices in the world today, you know, people might want to buy gold bullion. That's part of many people's idea of where to park. Cash is where to park as well, because these are, you know, the type of crisis where liquidity dries up, and that often forces people to sell, which often creates the downturn to go on further. So having liquidity means having actual cash that you can use to buy when everyone else is selling.
And in just a few moments, our special guest Danielle Park will have the final word.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Looking to advertise to targeted audiences? Online at talkdigitalnetwork.com or howstreet.com. On television, The Money and Wealth Show. And on radio, This Week in Money. To learn more about getting your message in front of our audiences, email us info@howstreet.com or call us 604-699-8600.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
And now, with the final word on today's program, here's our special guest, Danielle Park.
So I think the message that I want to leave people when I do my talks and in our conversations is one of hope. It's that I think really great opportunities are coming again in the not too distant future. And it may be within the next 6 to 12 months that we get another great buying opportunity, perhaps as good as March '09. So you want to be ready, you know, and be prepared this time. If you weren't the last time, this time have the strength and the cash to actually buy things.
Well, a lot of people were pretty stung and they're still pretty skittish. So these calming words of it's coming again, but this time you know it and you might be a little better prepared for it will help a lot.
Hopefully.
Good to see you again.
Thank you.
Thanks so much for dropping by. Danielle's website, jugglingdynamite.com. I recommend to visit as often as you have the time. Thanks to Fritz and the crew here at Churchill's in the Holiday Inn in North Vancouver for the superb hospitality, and for all of us at the Money and Wealth Show, I'm Sterling Fox, and we'll see you next time.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.